Hello, I'm Robin from All Time Conspiracies, and in this episode we'll look at the worst financial crisis to hit the world in over 80 years. We'll look at how decisions made in the past led to the crash of 2008, and how a culture of competitiveness and greed was allowed to grow in the heart of international finance. This is the banking crisis, declassified. The economic crash of 2008 was a financial disaster for everyone concerned, leading to significant unemployment not just in America, but across the globe. But the roots of the banking crisis can be traced back to the Great Depression in 1929. In 1933, Franklin Delano Roosevelt wanted to prevent a repeat of the Great Depression, which led to mass homelessness and unemployment rates of around 22%, so he signed the Glass-Steagall Act into law. This effectively separated commercial or high street banks from large investment banks like Goldman Sachs or Lehman Brothers. But in 1999, the act was repealed. The system of checks and balances that restrained banks from riskier opportunities had been removed. Nobel Prize-winning economist Joseph Stiglitz and Senator Elizabeth Warren blamed this deregulation for the 2008 crisis. But on the other hand, President Barack Obama says the repeal of the Glass-Steagall Act didn't cause the recession. So what really happened? In 2001, America entered a slight recession. Then the 9/11 attacks happened, massively damaging the US stock market. So the chairman of the US Federal Reserve, Alan Greenspan, reduced interest rates from 6.5% to 1% to boost market confidence. This meant that the traditional method of investment, which is buying US Treasury bonds, was less profitable. Instead, the lower interest rate made loans cheaper than ever. Investment banks saw an opportunity to make billions by using cheap loans to invest in real estate, which had increased in price by 10% every year. The scheme went like this. Homeowners needed mortgages to cover the high price of houses, so they would secure one from a mortgage broker. That broker would approach a local mortgage lender for the mortgage plus a commission. The homeowners then take out a mortgage, buy the house, and pay the loan back to the mortgage lender. Everyone wins. An investment bank then buys the mortgage off the lender and combines it with thousands of other mortgages they've bought. Now, every month, the homeowners pay their mortgages directly to the bank. The banks then arranged all the mortgages they'd bought into 3 classifications based on how likely the person repaying the loan was to default on their mortgage. There were certain or AAA loans, OK or BBB loans, or risky or unclassified loans. These classifications were then packaged into what is called collateralized debt obligations, or CDOs. Investors could buy shares in these CDOs. At the time, these were mostly safe, as mortgage lenders tended to prefer to sell to homeowners with stable incomes who were unlikely to default on their repayment. So investors, while the CDOs were safe, were making quite a lot of money. Everyone was happy. The problem came when investors and the banks wanted more and more of these CDOs. They demanded more than there was supply. In response, mortgage lenders reduced the requirements for a loan. Now, people who were more likely than ever to default on their repayments could take out a mortgage. These were called subprime mortgages, and these subprime mortgages and low interest rates continued to drive house prices even higher, and they encouraged people to take out multiple mortgages. But not all investors had confidence in the CDOs, so they took out effectively insurance policies against the CDOs defaulting. The banks then packaged these insurance policies into the CDOs themselves, ready to be sold off again to other investors, including other banks. And this is how the financial world became so entangled. If mortgage payers defaulted, the CDOs could fail, investors would then claim their insurance, and the banks would lose billions. But as long as the credit ratings agencies kept giving out AAA and BBB ratings, the banks kept doing it. But the credit ratings agencies were paid by the banks. And the former senior president of Moody's says the executive bosses encouraged analysts to give banks the ratings they wanted. Now, at first, the subprime mortgages seemed like a good idea. If someone defaults, the bank just takes their house and sells it for a profit thanks to rising house prices. But as more and more people defaulted on their loans, more and more houses were being left empty and unsold. Supply outstripped demand and house prices began to fall. The house of cards began to tumble. In mid-2007, inflation went up. Countries like the UK and elsewhere increased interest rates to 5.5%. This prompted the rise in the mortgage rates, initiating a flood of defaults on mortgage repayments. Then, in August 2007, BNP Paribas froze its assets when it realized how dangerous CDOs were. It was the first bank in the world to do so. A month later, British bank Northern Rock realized it couldn't sell enough mortgages to pay off its substantial debts. There was a run on the bank, and it's no longer around. Over the next year, global banks faced either bankruptcy, bailout, or takeover as the real estate bubble burst. Investment bank Bear Stearns was bought by JP Morgan, Merrill Lynch was sold to Bank of America, Lehman Brothers collapsed after losing $150 billion. Overall, CDOs are estimated to have lost between $200 and $600 billion. Meanwhile, countries around the world paid for the banks' gambling. In 2009, a $5 trillion global stimulus package was agreed. Economies throughout the Western world slowed to a crawl. The US economy lost an estimated $648 billion, as well as 5.5 million jobs. The government diverted $37.3 billion just to relieve both the financial sector and industries that suffered knock-on effects. Taxpayers bailed out mortgage lenders Fannie Mae and Freddie Mac, as well as AIG. All three were considered too big to fail. In 2010, the US passed the Dodd-Frank Wall Street Reform and Consumer Protection Act. This increased oversight and transparency in financial trading. However, Gretchen Morgenson of the New York Times says this act didn't go far enough. She says the nation's financial industry will still be dominated by a handful of institutions that are too large and too politically powerful to be allowed to go bankrupt. The Financial Times called for the introduction of a Europe-wide act similar to Glass-Steagall, but it hasn't happened. Simply put, the problem wasn't solved. Governments and banks are now massively in debt because of the money they borrowed to save the system, but currencies and the mortgage market are still weak. And in Europe, the first domino may be about to fall that will trigger an even worse recession. But that's for another video. All this has been merely prologue. So I hope you enjoyed and understood this video detailing the facts behind the events that led to the 2008 recession. It is a big topic. We tried to condense it and explain it in the best way possible, but I do urge you to look into it more, and hopefully this video has given